Imagine waking up on a random Tuesday morning. You check your investment accounts like you sometimes do with your morning coffee, and you notice something strange. Yesterday, while you were at work putting in your 8 hours, your portfolio generated $412 in gains. You do some quick mental math. After taxes, your take-home pay for that same day of work was about $320. Your money made more yesterday than you did. And then it hits you. This isn't a fluke. This is happening more and more frequently. Your investment returns are starting to consistently outpace your salary. You could, theoretically, not show up to work tomorrow and you'd still be making money. Not enough to live on yet, but the lines are crossing. Your money is starting to work harder than you do. This moment has a name. It's called the crossover point. And here's the thing that keeps me up at night. Most people will work for 40 years and never even know this moment exists, let alone experience it. They'll trade their time for money until they're 65, then hope Social Security and whatever they've managed to save is enough to scrape by. But there's another path, a mathematical inevitability that once you understand it, changes how you see every dollar you earn and every dollar you spend. My name is Bobby, and I spend way too much time thinking about the invisible milestones that mark the transition from economic slavery to true sovereignty. If you are someone who feels like you are running on a treadmill that keeps speeding up, or if you are obsessed with the idea of freedom but feel lost in the sea of vague financial advice, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today, we aren't talking about budgeting apps or how to save $5 on a latte. We're talking about the specific date on the calendar, a date that you can calculate right now, where you officially win the game of capitalism. Here's the thing about the crossover point that makes it so powerful. It's not a philosophy or a mindset hack or some vague notion of financial freedom. It's a specific, calculable, mathematically inevitable point that you will reach if you do certain things consistently over time. The concept comes from a book called Your Money or Your Life by Vicki Robin and Joe Dominguez, first published in 1992, and it's one of the most important ideas in personal finance that almost nobody talks about. Let me explain exactly what it means. You have two financial lines in your life that are constantly moving. The first line is your expenses, what it costs you to live each month. Rent or mortgage, food, transportation, insurance, entertainment, everything. For the average American household, this number is somewhere around $5,000 to $6,000 per month, though it varies wildly based on location and lifestyle. The second line is your investment income, what your money generates for you passively through dividends, interest, and capital appreciation. For most people starting out, this line is basically flat at zero. Maybe you've got a few thousand in a savings account earning 3%, generating $10 a month. That's not moving the needle. But here's what most people don't realize. As you invest consistently over time, that second line starts to curve upward, slowly at first, almost imperceptibly. But compound interest is an exponential function, which means the growth accelerates. That investment income line isn't rising in a straight diagonal. It's rising in a curve that gets steeper and steeper the longer you stay in the game. The crossover point is the exact moment when your investment income line crosses above your expense line, when the passive income from your portfolio exceeds what you need to live, when work becomes optional because your money is generating enough to cover your life whether you show up to a job or not. Let me put some real numbers on this because the math is where it gets really interesting. Let's say your monthly expenses are $4,000, which is $48,000 per year. At a 4% safe withdrawal rate, which is the standard rule of thumb for how much you can sustainably pull from a portfolio indefinitely, you would need $1.2 million invested to generate that $48,000 annually. That's your crossover point number, $1.2 million. Now, I know what you're thinking. Bobby, $1.2 million? I'll never get there. But let's actually run the math on how long it takes, because I think you'll be surprised. Let's say you're 30 years old, making $60,000 a year, and you're currently investing $500 a month, at an average annual return of 8%, which is below the historical average of the S&P 500. Here's what happens. After 10 years, at age 40, you'd have around $91,000. Your annual investment income at 4% would be about $3,600 or $300 per month, barely a dent in your $4,000 monthly expenses. The lines are nowhere close to crossing. But keep going. After 20 years, at age 50, you'd have about $275,000, investment income of about $11,000 per year, or around $900 per month. Still not enough, but the gap is closing faster now. After 25 years, at age 55, you'd have $430,000, investment income of about $17,000 per year, $1,400 per month. And here's where the curve really starts to steepen. After 30 years, at age 60, you'd have $670,000, investment income of nearly $27,000 annually. You're now over halfway to your crossover point, generating over $2,000 passively. At this rate, you'd hit the crossover point of $1.2 million around age 65, right at traditional retirement age. Now, you might be thinking, so I invest for 35 years and retire at a normal age. What's so revolutionary about that? And here's where I need to challenge everything you've been taught. That scenario I just described, investing $500 a month for 35 years, that's the slow path. That's what happens when you invest a relatively modest amount and wait for compound interest to do all the heavy lifting. But the crossover point isn't a fixed destination. It's a function of two variables, your investment portfolio and your expenses. And here's what most people don't realize. Reducing your expenses moves the crossover point from both directions. Let me show you what I mean. In our first scenario, you had $4,000 in monthly expenses, requiring $1.2 million to cross over. But what if you optimized your life and got your expenses down to $3,000 per month? Now your crossover number is only $900,000. You just knocked $300,000 off your target, which, at our investment rate, saves you about 7 years of working. And it gets better. If your expenses are lower, you have more money available to invest. Instead of investing $500 a month, maybe you can invest $1,000. Let's run those numbers. $1,000 per month at 8% for 25 years gets you to $860,000. Add in the lower expense target of $3,000 a month, meaning you need $900,000, and suddenly you're crossing over at age 55 instead of 65. You just bought yourself 10 years of freedom by making two adjustments, spending less and investing more. And here's where people really underestimate the leverage they have. What if you got radical about it? What if you house hacked and eliminated your housing payment? What if you moved to a lower cost of living area? What if you got your monthly expenses down to $2,000? Now your crossover number is $600,000. At $1,000 per month invested, you'd hit that in about 18 years. You could be financially independent in your late 40s, maybe earlier if you increased your investment rate over time as your income grew. The crossover point isn't some distant fantasy reserved for tech millionaires. It's a mathematical certainty that you can dramatically accelerate by attacking both sides of the equation.
This is where it gets really interesting, because I need to talk about what happens psychologically as you approach and then pass the crossover point. Most financial advice focuses exclusively on the numbers, but the mental transformation is equally important. When you first start investing, every dollar you put in feels like a sacrifice. It's money you could be spending on things you want right now. You're delaying gratification based on some abstract promise of future benefits, and honestly, it kinda sucks. The amounts feel trivial. Your portfolio goes up $30 one day and down $50 the next. The crossover point feels impossibly far away. But something shifts as your portfolio grows. There's a psychological threshold, and it's different for everyone. But for many people, it happens somewhere between $50,000 and $100,000. Suddenly, your portfolio feels real. A 2% gain isn't a few bucks anymore. It's $1,000 or more. You start to viscerally feel compound interest working. Your money is doing something. It's alive. And your relationship to work starts to change even before you reach the crossover point. This is what I call the freedom gradient. Most people think of financial independence as binary. You're either dependent on your job or you're not. But that's not how it feels in practice. As your investment income grows, you become incrementally more free. When your investments generate $500 a month, that's your car payment covered passively. When they generate $1,000, that's your car payment and your groceries. At $2,000, most of your non-housing expenses are covered. Each milestone gives you more options, more bargaining power, more ability to say no to things you don't want to do. You don't have to wait until the line's fully crossed to start feeling the benefits. There's a concept in the FIRE community called coast FIRE that illustrates this perfectly. Coast FIRE is the point at which you've invested enough that even if you never invest another dollar, compound interest alone will grow your portfolio to your crossover number by traditional retirement age. Let's do the math. Let's say you're 30 years old and you want to have $1.2 million by age 60, 30 years from now. At 8% annual returns, working backwards, you'd need about $150,000 invested today to coast to $1.2 million without adding another cent. If you're 30 with $150,000 invested, you're at coast FIRE. You could theoretically switch to a lower-paying job you love, work part-time, or just stop investing aggressively and use that money for experiences instead. Your retirement is mathematically locked in. You've punched your ticket. Now, I'm not necessarily recommending this strategy because continuing to invest obviously gets you to full financial independence faster and gives you more margin for error. But understanding the coast FIRE shows you how the crossover point creates options long before you actually reach it. A 2022 survey from Empower found that 57% of Americans believe they'll never be able to retire comfortably. But most of those people have never calculated their crossover point. They've never realized that they have a specific number to aim for and that there are concrete actions they can take to reach it faster. They're just vaguely worried about an undefined future, which is psychologically paralyzing in a way that specific goal setting is not. Let me address some objections because I know what you're thinking. Bobby, the stock market is volatile. What about crashes? What about inflation? What about all the things that could go wrong? These are legitimate concerns, and I'm not going to pretend the path to the crossover point is a straight line. It's not. You will experience market downturns. Your portfolio will lose 20, 30, even 40% of its value at some point. The average bear market happens about every 4 years, and the average decline is about 33%. This is normal, this is expected, and it's already factored into the 8% average annual return we've been using, which includes all the crashes, recessions, and panics of the last century. The key is that you're not withdrawing money during the accumulation phase. When the market crashes, you're still buying. You're buying more shares at lower prices, which actually accelerates your progress to the crossover point, even though your portfolio balance drops temporarily. Dollar cost averaging through downturns is one of the most powerful wealth-building mechanisms available to regular investors. It only works if you don't panic sell, which is why understanding the crossover point psychologically is so important. You're not tracking your portfolio for entertainment or anxiety. You're watching the gap between two lines slowly close, knowing that temporary setbacks don't change the mathematical inevitability of where you're heading. As for inflation, the 4% safe withdrawal rate is specifically designed to account for inflation. The original Trinity study that established this rate tested portfolios against historical periods that included high inflation, and the 4% rule held up. Additionally, stocks have historically been an excellent inflation hedge because companies raise their prices along with inflation, which flows through to their earnings and stock prices. Your crossover number will rise with inflation, but so will your portfolio. They roughly track each other.
Is there risk? Of course. The future is uncertain. But the alternative, never investing and remaining completely dependent on trading your time for money until you physically can't work anymore, is not less risky. It's more risky. You're just trading investment risk for longevity risk, health risk, and labor market risk. At least with the crossover point strategy, you have a mathematical plan that has worked for everyone who has actually executed it consistently. Here's what I want you to actually do with this information, because understanding the crossover point is useless if it doesn't change your behavior. First, calculate your current monthly expenses. Not what you think they are, what they actually are. Go through 3 months of bank statements and add up everything. Be honest. Most people discover they're spending 15 to 20% more than they thought. This is your baseline reality. Second, multiply your monthly expenses by 12 to get your annual expenses, then multiply that by 25. This is your crossover number at a 4% withdrawal rate. Write it down. This is the portfolio size that would make work optional for you. Third, check your current investment balance. Subtract that from your crossover number. This is your gap, the distance between where you are and financial independence. Fourth, figure out how many years until you close the gap based on your current investment rate. There are calculators online for this, or you can use a compound interest formula. Be honest about what you're actually investing each month. Fifth, and this is where the action happens, ask yourself how you could accelerate this timeline. Could you increase your income through a job change, side hustle, or skill development? Could you decrease your expenses by housing hacking, relocating, or cutting vampire costs? Could you invest windfalls like tax refunds, bonuses, or inheritances instead of spending them? Every $1,000 you invest is $40 per year of passive income forever. Every $100 you cut from your monthly expenses is $30,000 less you need to reach crossover. I want to leave you with a reframe that I think about constantly. Every purchase you make has two costs: the money you spend and the crossover time you sacrifice. When you buy a $30,000 car instead of a $15,000 car, you're not just spending an extra $15,000, you're pushing your crossover point further into the future. At 8% return, that $15,000 would double approximately 9 years. So that car upgrade didn't cost $15,000. It cost $30,000 over 9 years, $60,000 over 18 years, $120,000 over 27 years. It cost months or years of freedom at the back end of your life. I'm not saying never spend money on things you enjoy. I'm saying understand the true trade-off. That money isn't just money, it's future time. It's the months you'll spend working when you could have been free. The crossover point makes this trade-off visible and quantifiable, and once you see it, you can't unsee it. Every financial decision becomes a question of whether you're moving toward the crossover or away from it, whether you're buying yourself freedom or selling it. The average American will earn about $2 million over their working lifetime and end up almost completely dependent on Social Security in retirement, which pays an average of about $1,800 a month. They'll have worked for 45 years and have almost nothing to show for it, because every dollar that came in went right back out. The crossover point offers a different path, not an easy path, but a clear one. Save aggressively, invest consistently, reduce your expenses intelligently, and wait for the math to work. The lines will cross. They always do for the people who stick with it. And when they cross, you'll wake up on some random Tuesday, check your accounts, and realize that your money is finally working harder than you are. That's the moment everything changes. I've spent way too much time thinking about this stuff, so you don't have to. If this video helped you see your finances differently, make sure to smash that like button and subscribe for more content that challenges how you think about money. I'll see you in the next one.